This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Help attract more borrowers and build a more resistant loan portfolio. Payment Guard Insurance from TrueStage is a first-of-its-kind insurance solution designed for digital lenders to do just that. Visit www.truestage.com/payment-guard to learn more and talk with a member of the TrueStage team. Hello, and welcome back to the Fintech Takes podcast. Today I have a very special episode for you. We have a guest who is going to do a little educating on today's podcast. I, as you guys know, have spent a lot of time diving into the world of generative AI, large language models, just the advances generally that we're seeing in AI and how they apply to financial services. And I think in the hype around AI, we sometimes lose track of what these actual technological breakthroughs are good for, where they maybe don't work quite as well, and specifically within financial services, where we have plenty of regulation and other constraints that sort of limit what we can do, where can we get the most practical value out of some of these technologies? So I am absolutely delighted to be joined today by Rohan Ramanath, the co-founder of Hyperplane, which is a fintech company that you may not have heard of, but I think that you will hear more about in the future. Rohan, thank you so much for joining me.
Hey, Alex, thank you so much for having me. Been a huge fan of the podcast, and so very happy to be here.
Excellent. Well, I appreciate you coming on. As I said at the beginning, your goal is to be educating me on all of the things that I don't know and answering some of my dumb questions, particularly on the subject of AI. So before we get into that, I'm hoping you can just do a quick introduction on yourself and then just a little bit of background on Hyperplane as well.
Absolutely. So I was born and raised in India. I'm an engineer by training, got introduced to machine learning very early on. So I was working in Microsoft Research, where there was this problem of understanding user intent from web search queries. This was for Bing. And this resulted in a few papers published at one of the top conferences for NLP. Got me interested enough to go and specialize further. So I went to Carnegie Mellon. I was in the master's program for machine learning and NLP. I then got admitted into the PhD program, but I felt this need to get my hands dirty, build data products before going any deeper. So I joined LinkedIn, and they had a very good data team, a lot of data problems to solve. And I got exposure to a bunch of data and AI problems there, right from like, how do you learn user behavior from unstructured data to matching products to people in two-sided marketplaces. And finally, the recommender systems piece, right, which is a holy grail for most social networks today. And so when I left LinkedIn and we wanted to start Hyperplane, the core hypothesis for the company was there are a lot of these same problems in financial institutions, and about 80% of the data that banks own today are unstructured data. So what does it take to build that data intelligence layer that can connect to first-party sources of unstructured data and transform them for decision-making, predictive modeling, recommender systems, those kind of applications and problems, right? And so that's what we're trying to build with Hyperplane.
Before we get into banks and all this unstructured data they have and kind of specifically what you're focused on helping them with, I'm wondering, I mean, you've worked in machine learning and natural language processing, both from an academic context and then in a real world context, far longer before this kind of current AI craze kicked off. And I sometimes get a chuckle out of everyone who's sort of new to the AI field because, I mean, even like in financial services, I worked at FICO. We were using machine learning at FICO in the 90s, the 80s. I mean, this is not like a new area applied to financial services. However, there is obviously a big step forward that we've seen with large language models and just some of the kind of foundation models that are being built right now. So I'm curious if you can kind of, from your perspective, being sort of deep in this field and even just from like an academic perspective, why are LLMs a significant step forward in this field?
This is a very fair question in today's climate, right? Like, I think the AI engineer or data scientist or machine learning engineer is probably the broadest title that you're going to find online, because there's a wide range of people that qualify for that title, but the kind of work they do varies significantly. And so To answer your question on why LLMs and what has changed with Chat GPT, banks have needed and built predictive models for longer than I have existed, way before Chat GPT.
Yep.
And most of these models are built by a few data scientists where they handcraft features, right? They look at structured or tabular sources of data. They slice this data differently, stare at different cohorts. They see if something stands out. Are there like variables in this data that predict behavior? And they stick in these features as indicator features in predictive models. But this works well for structured data. And so ChatGPT and LLMs have really unlocked the power of unstructured text data, the kinds of data that banks have had, but have never really used until now. And a lot of the power behind these LLMs is they are unsupervised, which means I don't need a label from the user. I mean, technically they're self-supervised, but it still means I don't need a user to tell me what happened. And they learn through compression. What that means is if you have 10 terabytes of training data, a good LLM will compress that entire 10 terabytes of data into its own model. And it does this through a generative process, right? It predicts the next word in the sentence or the next token. And that itself is training data for it to compress the data. But to go one level deep, to compress the data well, you need to understand a lot of the hidden secrets about the data. How do you reason about things, the semantics, the objects, the actions of the world? So one could make the argument that if a model is able to compress well, it really understands the world well. And if you understand the world well, can you use that to solve all of the other tasks that you need to solve? Right. And so that's the reason LLMs are a good engine to represent the user, to represent behavior, to represent any kind of feature that can generalize across tasks.
Okay, that is super helpful. That's probably the best explanation I've heard of just like, in simple words, why is this a meaningful step forward? By the same token, though, and I think this applies very much to what you guys are specifically doing, but I also sometimes see in the hype around generative AI, LLMs being sort of compared to magic and they can do anything and they should be thrown at every problem. What are some of the kind of key constraints or things that folks should keep in mind with LLMs in terms of where they might not work as well or where they might need to be supplemented by other techniques or other technologies?
I want to decouple two aspects of LLMs, ChatGPT, and all of that, right? Like,
Yeah.
there's the generative AI aspect of it, which
Yep.
is using a generative process to train a model. And then there is a chat-like interface to interact with the model, right? And you don't need to always use these two together. You can have a generative process to train a model, but use some other interface to interact with it. Now, a big problem that has been mentioned time and again with a chat-like interface is models tend to hallucinate. Models tend to make up facts as they interact with you when they emit text data. So anytime you're going to position a product that's going to interact with your consumer, you need to have guardrails around it to prevent it from saying things are simply untrue, especially in like high consequence use cases. This becomes very important.
Yep.
Another thing that they don't work well with is financial data, right? Because if you think about the data they've been trained on, and this is not just specifically financial data, they're not good with any kind of proprietary data, right? Because they've been trained primarily on internet data, publicly available web text data. So anytime you have a use case that you will do 10x better if you use proprietary data, the public LLMs are probably not the best thing to throw at it, right? And so a lot of the times, a commercially facing LLM solution is often more than a single model. It is a complex system that involves humans in the loop, a knowledge graph, a search engine, evaluation benchmarks, a way to evaluate bias, fairness, segmentation of different user groups, guardrails, tracking, reporting. And so it really is a complex combination of systems put together that work seamlessly well for one or a few use cases.
And so speaking of use cases, I mean, and I want to build off of what you just said a little bit. One of the things that I see as kind of a default assumption, I guess, in the sort of financial services use cases that are being built on top of these foundation models is this idea that you do have to kind of use both the generative self-supervised learning and the chat interface together. Like those things are treated as a package. and I'm going to interact with one of these sort of foundation models that's available for others to build on, whether it's GPT or Llama or what have you. And the idea, I think, is we're going to apply that sort of foundation model with the guardrails and other things that get wrapped around it. And then we're going to add sort of our own sort of reinforced learning layer on top, or our own guardrails to kind of create our own use case. But the idea is essentially that we're going to take the generalized, sort of trained on the entire corpus of text from the internet model, and we're going to then sub it in for tasks where we are currently using human beings for low-level, but kind of somewhat generalizable or hard to replace tasks that human beings do. One that I always think about in the context of like business lending is when you're doing an evaluation of a business and they give you an address and you need to make sure that it's actually a pizza restaurant at that address. We've gone from a site visit where someone gets in their car and drives to that address and looks to make sure there's a pizza restaurant there, to then Google Maps, where I pull up an image on Google Street View, but I still need a human being to look at that image and note that it's a pizza shop, not an apartment building, right? Like that's just a hard enough problem that training like a really specific OCR model to try to tell the difference is not going to work. Whereas a more generalized model that can sort of mimic low-level human intelligence would be able to sort that out relatively well. I think there are a lot of values and a lot of use cases in financial services and in other industries where you can use LLMs in that capacity. You guys, though, are using it in a slightly different way. And I'm just curious if you can kind of explain the approach you're taking and kind of tying back to this unstructured data problem that banks have.
I think that was a great example, right? I think the example you gave about predicting whether this is a legitimate establishment is a predictive problem.
Yeah.
Right? Yes, a human can interact with an agent to like get some of these answers, but you could have an API that gives you a probability of how likely is this to be legitimate, along with some evidence on why it thinks it's legitimate. And you could have this populated on a dashboard and make the human 10 times more effective or efficient in doing this. So the niche that we are targeting is the predictive problem space, right? And this could be any time where you have a model estimate the likelihood of a user doing a certain action. That is a predictive problem, right? So that's the output space of our LLMs. It's only designed to extract features to predict, is this user going to do X or not do X? And the input space to our LLMs are only financial data, right? We don't care about web text data. I don't care about making my LLMs 10x better at the SAT or the GRE or the bar. I only care about helping the LLM extract consumer financial behavior as well as features that are important for financial institutions to make decisions about the user. So we've constrained both the input and the output space of what our model needs to do, right? And so now the question becomes, if you're going to focus on such a narrow niche within the financial industry, does it make sense for you to have a 100 billion parameter model? Do you need to train on all of the data on the internet to learn about consumer financial behavior? Likely no, right? But then if you start with the data that a bank already has, you could do a lot better than a generic model if you pay attention to how does the model attend to different modalities of financial data? How do you improve the model's ability to generalize across tasks? So instead of training a task to predict whether the business is legitimate and what financial products to recommend to this business, what would the world look like if I had a singular representation of this business from a financial perspective and use that representation on both those models, right? So we've decoupled the feature representation from a financial perspective and the ability to train downstream models for predictive applications, right? So this led us to a world where we started creating these proprietary architectures or encoders of financial data and deploying these inside the infrastructure of a bank. So the data of the bank never has to leave their cloud, right? So this is very sensitive data. It's data that's never been ingested into public LLMs, but can be learned rich representations about the user to help recommend better products to them, right? To help bank employees perform more effectively, more efficiently, more accurately with better feature representations coming out of the LLMs.
That's fascinating. And it's particularly interesting to me. I mean, you touched on the idea of the data staying within the bank's walls, right? And I've sort of conceptualized these different approaches to using LLMs in kind of the analogy of the intern versus the experienced executive, right? In the sense that, the broadly trained on the internet corpus of data version of this model is like this really capable intern that can do a bunch of stuff that, generally like adult human beings who, graduated from high school and graduated from college and maybe took the LSATs can do, but they have like no experience at all inside of like the industry that they're working. And so there's sort of this like this Labrador retriever that you can like throw at a task and it goes, oh yeah, I'll go do that, and comes back. And obviously it'll hallucinate. It's a little over eager, but it's tireless and you can task it with these low level things. But what you're describing is this idea that, as you said, 80% of data captured inside of financial institutions' walls is unstructured, right? So it's all of this data that paints a very rich picture of what the bank's customers are doing, how all the different banks' processes are doing, all the different decisions that a bank is making. But all of this data, for the most part, is unstructured, meaning that it's very, very difficult for the traditional approaches to machine learning to extract useful features from it that can then be applied to predictive models, even though the data itself would be highly predictive and highly useful in driving some of these decisions. And I guess the point of comparison then would be, imagine that there's a really experienced executive working at that bank that can just automatically know all of this data and just keep it in their heads. Like, what would they be able to predict? What insights and intuitions would they have? And so this is kind of unleashing that same capability, but against a much richer and sort of harder to get to data set, and one that banks, I would imagine probably don't want to let outside their walls or exposed to the open AIs of the world. Is that a fair way to think about it?
That's absolutely it, right? Because we understand how sensitive this data is. And even with the same model architecture and the same training protocols and all of that, two of our customers will be training on completely different sets of data. So the quality of the model that we produce for both of them are going to be different. And so the person with the richer source of data is going to have a better model. So they're not really compromising on their competitive advantage by working with a platform that helps them train their models. That being said, right, we are opinionated about the kinds of data we allow them to onboard onto the platform, right? It's not like we go to the bank and say, hey, give us all of your unstructured data. We're going to build you a model. Instead, we have a list of sources of data that for our current level of maturity, we're already ingesting.
Let's talk about those. Yeah, because I wanted to get into like where, if you were to look at like unstructured data, that 80% is this like, shaft going down into a mine, and you're starting to figure out like where you want to focus. What are the richest veins of ore in that mine, so to speak?
The most commonly used data sets for us are bank transactions, user engagements, and product usage data.
Okay.
Now, some of these might sound structured to you, like bank transactions are like, oh yeah, I have a database with transactions. So if it fits in a database, it should be a table. If it's table,
Sure.
It's tabular. So is it structured? But oftentimes, transactions have a description field, which is text. And that description has no schema whatsoever, right? Sometimes you find merchant information there. Sometimes you have like how many payments have been made. Is it a multi-part payment, single-part payment? Is it subsidiary, location, amounts, and all other metadata gets encoded into that description of the transaction. So it's very much unstructured, and most teams don't use it for any kind of predictive modeling. The next is user engagements, right? Any type of user interaction on your mobile app, your web app, which product was used last, how often are they using it? Have they spoken to any kind of customer service agent in the past? Notes from that conversation, phone logs, all of this is text data. It makes up a vast majority of the data that is stored, and it's super dirty. Now, the reason we have to be opinionated about onboarding each type of data independently is we encode them differently into the model. So even though it's a single foundation model per customer, there are different free ways that we build to encode each source of data to enter that model, right? And we spend time as we onboard every single source of data for each customer, right? And there are two ways to encode intelligence into the model. The first is the architecture of the model. The second is the weights of the model. And we do the architecture method because if we are encoding intelligence through the weights, then you have the circular dependency on whose data did you use to train the first model that you're now selling to another customer? Right. So we stay away from that completely and say that we are going to train the model from scratch with your data, and there's no other data that is used. The reason we started with transactions is transactions are like the lifeline of the consumer economy, and you can figure out a lot about what kinds of brands does a consumer shop at, what kinds of financial products do they really want, do they really need, what they'll benefit from, what is the best time to engage them on a different financial product that you want to sell them on. All of those, the answers are in the transaction data.
That makes sense.
Just one thing before I complete that, right? Like we're always on discovery for new sources of unstructured data, right? One thing that gets brought up often is there are a lot of unstructured sources of data on the commercial banking side that would be useful for Hyperplane to ingest. But this is not something we've done yet, right? But most of the technology stack we've built would scale to that use case. But we're doing this discovery to figure out what are sources of data that will exist across banks, no matter what kind of bank they are. Right. And bank transactions is that one example where, however small of a bank you are, you're always going to have enough transactions. Even if you have few users, you're going to have a lot of transactions for you to be able to get to a good point in terms of model training and convergence and those things.
Got it. That makes sense. So just reflecting that back to make sure I understand, it sounds like when we talk about unstructured data, there's kind of this notion that, like, again, 80% of banks' data is unstructured, but that doesn't mean it's all unstructured in the same way, right? And so, like, to use transaction data as an example, and it sounds like this is kind of what you're describing, I've always thought of transaction data as like just unstructured enough to be super annoying to model against in a traditional fashion, right? Where it's like, is it stored in a database? Yeah. Is it, stored in these tables? Yeah. Can you sort of extract or backwards engineer some meaning out of that? Yeah. But it's just not quite structured enough or cleanly labeled enough that it becomes super annoying, which is why all of these different infrastructure providers exist around data enrichment and all of these things. It's about cleaning the data and making it more usable, right? So that's, I think, a really good example of one that's like structured-ish, but not like structured enough to work in a traditional context. Versus, as you were saying, like the customer engagement data, where if it's a transcript of a call that I have with a call center agent, that's like super unstructured relative to like transaction data. So it sounds like it does span the gamut, and the architecture that you build around these models is somewhat designed to help you kind of parse different types of unstructured data.
Absolutely. I think you touched upon a very interesting point that I'd almost forgotten. Transaction data is not just annoying, it's dangerous because of how it looks structured but unstructured. And how that shows up is it's very easy for you to set rules on transactions saying, hey, if the user's balance drops to zero anytime in the month, that's a negative feature. Right? Very easy to set this rule. But we've seen customers that have hand-coded these kind of rules. They've launched models online, and the models look good on the day they launch. But these kind of features can degrade very quickly. 6 months later, these features are completely uncorrelated with the label, right? So extracting features from data sets like transactions, you'll have to extract features at the concept level and the semantic level, and not just these simple things that meet the eye, like the balance and the amount and the merchant information. Right. So internally, we have experiments to show that even the best hand-engineered, enriched transaction features are like a few orders of magnitude away from what the LLM can extract automatically.
It's fascinating. And it does tie back to this notion of human intelligence, just in the sense that, like, with a lot of this stuff, there's just a little bit of nuance attached to these things that an experienced person, an executive working in this space who knows this data inside and out, would kind of intuitively pick up on when they're, interacting with this data. But when you're extracting features and building them into a model, you don't have that same kind of contextual, nuance-based judgment built into it.
Correct. And our hope is that the multiple modalities of data that exist inside a bank captures all of that context, that ability, that enhances the ability of the LLM to catch up to that executive in the bank.
Right. It's a scary thought for the executive at the bank, but we'll circle back to that at the end. So I wanted to ask you, this is more of a sort of go-to-market question, because I spent most of my life selling to banks, and I'm curious to get a little bit of insight from you on a couple of questions. The first one is, this strikes me as both a very interesting horizontal capability that you could sell broadly to banks. So as we've been talking about, this applies to a lot of different types of data. cuts across a lot of different use cases. A lot of, I think, companies, particularly in the analytics space, tend to try to sell sort of a horizontal platform, and maybe they'll sell it to the sort of chief analytic officer or chief risk officer, or maybe it's the chief technology officer. But it's kind of a horizontal, almost infrastructure play. By contrast, and this is where most of my experience has been personally, the other approach to selling into banks, particularly large banks, is to focus on lines of business and use cases and very specifically kind of honing in on, I guess I would say, more business value as opposed to technical value. Which approach have you guys taken so far?
We took the latter, right? So we want to sell to the line of business or the product team and not to the engineering team, even though everything we discussed up until this point was horizontal technology, right? You go from raw unstructured data to feeding the LLMs, extracting the features, and then training predictive models. This can be used in every line of business. Banks have over 100 predictive models, and selling to the CTO or the data team seems like the more natural fit. But we decided to start from the business side for two reasons. As an AI startup, there is the easiest way to pigeonhole yourself is to get into insights or analytics. You have all of this unstructured data that doesn't make any sense, but it's very easy for the model to get these super unique insights about trends that it's seeing with your users. And we didn't want to just expose those insights because now you're stuck with what is the business value of these insights? We'll have to work with our customers to help them figure out, is this a nice to have? Is this a must have? How much money should I spend on this? How much time should I spend on this? And we didn't want to do all of those things, right?
It's kind of like a magic trick, right? It's like, you come in and you apply your analytics to the thing and like it generates some insight where I was like, wow, how did it figure that out? So it's like flashy and it's cool that way. But like then the next conversation is, what do we do with that?
Yeah, one of our earlier customers, we helped them figure out that, hey, the 20% of your users are increasing their ride sharing usage on your platform, right? And the model automatically figured this out, but like the so what question was still in the loop.
Right.
So most of our predictive APIs are designed to track some business metric. We sell to like the owner of the credit card unit, right? Their goal is to drive credit card sales. So if you train a predictive model to now cross-sell credit cards among all digital banking users, the model is trained to predict which customers are going to now buy your credit card in the next 30 days. If the model does well, you're going to see an uptick in the number of users buying that credit card. So it's one hop away from the business metric. It also helps us identify if we're working on something meaningful or are we wasting our time, right? We want to get to that conclusion as quickly as possible. In 3 months, if we can exit a pilot through a back test or an A/B test to say, this is how much business value we added because you're able to target users more narrowly now. You're able to bring the product to the needs of the user at the time they need it. And this is converting a lot more users. We are doing something meaningful and we're aligning our success to the success of our customers.
TrueStage Payment Guard Insurance is a first-of-its-kind insurance solution built for digital lenders, designed to help you attract more borrowers, strengthen your loan portfolio, and reduce time spent on collections, all with minimal tech lift needed to go live. To learn more about Payment Guard Insurance, visit www.truestage.com/payment-guard and speak with a member of the TrueStage team. Those business buyers, they're delightful. I mean, they're a pain in the ass, but they're also delightful in that, like, they'll keep you focused on that stuff where you'll give them this great thing and they're like, so what? Because they're so P&L focused. They're like, this doesn't drive profit or loss for me. I don't care, right?
Correct.
Like, as cool as it is, I just don't care. And so it is a nice way, I think, particularly for earlier stage companies to stay very focused on always triangulating to like the most business value possible. I think that makes a ton of sense. There's always like the ability to expand into platforms and sell horizontal and do stuff later. But I think as a beginning strategy, that makes all the sense in the world. You guys got started in Brazil, correct?
Yes. So Brazil was a good starting place for a product like ours for a few reasons. A lot of our customers in Brazil are far more digitally like data sophisticated. They have the data we need on the cloud already. So it allowed us to build Hyperplane as like a data intelligence layer on top of their cloud or their warehouse. Now, the open finance regulation by the government made also, I think a lot of the open finance regulation went in about 2020, 2021. So the larger banks in the network were already exchanging the kinds of data we were working with each other, right? So they were on the market looking for a vendor to help them make sense of this incoming data because no one was using this data. They were sending and receiving huge volumes of data about their customer as required by law every month. But this data was just held up in a cloud storage account. And they were really not figuring out anything about the incoming user or changing their personalization strategies or tailoring their existing products to the needs of the user. And so it made it, we didn't have to explain the problem to our customers when we went knocking on their door. They were already looking for someone to work with the kinds of data that they were losing to some of the other banks in the network.
I was going to ask, I mean, as you guys have worked in Brazil and I've had a couple conversations recently about like Brazil is almost like what the US banking market would look like if it made more sense. Not to be too mean to the US banking market, but there are a lot of things that make sense in Brazil in a way that I wish did in the US. But as you guys sort of kind of get scaled up in Brazil and sort of test out some of these different use cases and then kind of prepare to move into other markets like the US, what are, in your experience, kind of those top use cases or areas where so far this is really resonating or tying back to like, wow, there's some really great unstructured data inside banks that can really inform this use case that drives this business metric?
I think with open finance and Brazil, there were some very simple questions that banks were trying to figure out that we had not thought about, right? Because we are outsiders to the financial ecosystem, right? Like things like every bank wants to figure out the share of wallet they have.
Yeah.
Right? What percentage of my users treat me as their primary banking relationship? Now, it's a predictive problem. You can solve it with transaction data. You can solve it with open finance data. So this was the problem that they were looking for answers to when they were looking for a vendor. But once we saw how effective transaction data was, we didn't have to restrict ourselves just to open finance data because open finance, even with a 1% adoption rate, that's a very small fraction of the data the bank owns.
Right.
You could use all of the internal data to effectively cross-sell products to existing customers. Most banks are turning into multi-product platforms. Every bank in their earnings are tracking the average number of products the consumers are engaging with. Banks are slowly figuring out that users that engage with more products have higher retention, higher LTV, lower churn. So there's a huge emphasis on cross-selling. And there is also this is not just a recommender systems problem, right? It's also about, like, there are banks with 5 different credit offerings.
Yeah.
So if I am a consumer and I need a line of credit, what is the best line of credit I should use? From my own financial journey's perspective, which one would I come out ahead if I'm going to take 3 months to repay, 6 months to repay? Which one has how much fees, how much interest? All of this is a black box to the consumer. I gave you a credit example, but if you go to any bank's website, there are 3 or 4 savings accounts.
Oh, yeah.
Each with a fine print of how each account is slightly different from another. And it takes a lot of staring at that website for a long time for a human to figure this out. There is a future world where the cross-selling engine can simulate for the user what their life would look like with each of these products, recommend the right product to them, and then solve the discovery for the consumer, right? Banks will not be able to play the discovery arbitrage for too long. So when we are doubling down as a company, as we enter the US market, is this cross-selling hook. So banks that have at least 1 million users, they have the multi-product focus, they have some amount of data on the cloud. That would make for a great pilot for us to quickly showcase what is the business impact of you investing in this technology. Now, one of the artifacts of us focusing on the business user as opposed to the technical user early on, it helped shape the product. It helped shape the product because everything we spoke about in the first half of this conversation was the foundation model, was the LLM piece. But that itself is not the product doesn't end there, right? If we just start with the foundation model and that was the product, it would have taken us 6 to 9 months to show some kind of impact with every customer. And an average business user does not have that kind of patience to tolerate a new vendor on the market.
That's true.
So we built out all of the platform ecosystem we need around that foundation model to show value quickly. It takes us 2 weeks after the data touches the cloud for us to turn back around with the first set of predictive models to show them business impact. And if we show a 20-25% increase in any business metric, is that large enough for them to continue engaging with us for us to evolve that architecture over time to deliver that 2x, 3x, 4x improvements in retention, reduction in churn, or whatever business metric the marketing team then cares about.
I'm fascinated by sort of what happens when this becomes more of a sort of common capability inside these banks. Because to your point, there has been this discovery arbitrage that's existed in banking for a long time where, kind of goes to your point about share of wallet or number of customers, number of products per customer. Wells Fargo had customers captured in their branch, and they went a little crazy in terms of like opening accounts up without people agreeing to it, but they didn't even really need to do that because the reality is, as a Wells Fargo customer, in the 90s or the early 2000s, you weren't looking around at other places. You weren't really like shopping around or getting good information. You were just sort of subject to what was on the bank's website, what was in their mobile app, what the teller would tell you when you came into the branch. There was this ability to sort of limit discovery or to steer behavior. And I'm fascinated by how this looks in an open banking context. Obviously, the US is a little behind Brazil in terms of our move towards open banking, but the director of the CFPB has made it very clear. I just saw him speak in person recently about this, and he's very clear that the end goal that we have for open banking in the US is to create a much more competitive, fluid market where financial accounts and financial data are portable. And, it's funny because I think one of the things I've always kind of suggested to banks that they try to do or think about that I usually just get like eye rolls when they bring this up is, well, you should try to engage your customers more on like what their financial journey is and what they're trying to accomplish, right? And like give them reasons to connect all their different accounts together. Give them reasons to like tell you things about their financial aspirations, what they're trying to accomplish, where they're going. And outside of a wealth management context, where you have a human being on the other side of that conversation, which is reserved for high net worth individuals, no other bank customers really have that kind of experience or that interface to like share with the bank what they're trying to accomplish. And I kind of think, after having had this conversation and thinking about the role that generative AI plays in all this, I kind of think part of the reason banks haven't done that is they know if we do that, all we're doing is creating a worse big data problem for ourselves, right? Like, say we do that, say we go capture this data or we create some interface that lets customers tell us about their financial goals in a digital sense. What are we going to do with that data? It's just unstructured data that goes into a warehouse that we never touched or see or used before. But what you're describing is a vision of if I, as a bank, can engage my customers in telling me more about what they want to do and telling me more about their financial lives, pairing that with all of the first-party data that I already have, much of which is already unstructured, and pairing it with all of this other data that I can get the customer to share with me through open banking, I've created this like rich tapestry of exactly what the customer is doing today and where they want to go. And that should be able to drive really powerful predictive models in the same way. I mean, I know this is trite, but we've talked forever about why don't banks have an Amazon.com or Netflix-like recommendation engine attached to what they do? And it's largely because a lot of this stuff is just unstructured enough or just complex enough that it sort of eludes the ability for those analytics to do a good job on that. So it sounds like that's the boundary that you're pushing on.
Absolutely. And I think this was surprising to me, but as we entered the Brazilian market and started speaking with the banks there and started working with on different products, we realized that a lot of banks have a marketplace. So the Amazon.com, like banks in Brazil are now having e-commerce marketplaces.
Yeah.
And so the lines between a technology company and a bank are starting to blur. And if everything we spoke about so far, if a technology company were to become a bank, how they would approach all of these problems are very different from how banks are approaching all of these problems. We spoke about the marketing and cross-selling use case, but even retention, right? Banks have, let's say, some amount of budget per user that they want to spend to retain those users or to just acknowledge that these people have been valuable members and they want to thank them for it. They do have retention campaigns that they're running today, but they're doing it from a place of not knowing what is important to the consumer. So they end up sending them offers or rewards that are like, I mean, the consumer is going to be happy because they're getting something, but they'd be a lot happier if you were a lot more thoughtful. It's like, if you invite me to your birthday and I give you an Amazon gift card because I don't know you well enough, how would that make you feel versus me actually taking the time to be more thoughtful about spending the same amount of money, but telling you or making you feel like I want to give you something that's meaningful to you.
Well, shit, you could spend less money, right? I mean, that's the
Yeah.
thing that's so interesting is that there's an efficiency to being better at predictions with this stuff, right? Because I think about that a lot, actually, I think I've told this story before on the podcast, but when rates were going up in the US, I'm a terrible financial services consumer, even though I do this professionally. And so I don't optimize my finances as much as I should. And I'm kind of like lazy, dumb money that doesn't chase rates as much as I should. But I had this question in my head of, well, I wonder what my savings account provider is doing, because they were high yield at the time that I opened it, and that meant nothing at the time. And like, I wonder what they're doing. And this is a top 10 bank, let's say.
Yeah.
And I went in and I opened the account, and this was a bank that I had a checking account, a credit card, which is my primary credit card that I spend quite a bit of money on, and then a savings account that's high yield, supposedly. And I was dismayed to find that I was not getting anywhere close to the interest rate that I could have been getting from other providers, or that if I had signed up as a new customer to the same bank, that they would have paid me walking in the door, right? But the whole business model was built around that arbitrage and that ability to keep deposit betas low. And so they were like, well, Alex is stupid and he's never going to look at this. And the thing that struck me as being really ironic is I wasn't even looking for them to max out my interest rate. I probably should have been, but honestly, as a customer who likes this bank otherwise, I was just looking for an acknowledgement that we value you, right? And so it could have been half as much of an increase as what the rest of the market would have given me. And I could have logged in, seen that, and go, oh, so they're taking care of me. They're predicting what's going to happen. They know that, like, I'm feeling a little restless, or that, like, they just know I'm a valuable enough customer that it's worth spending that little bit of money to retain me.
Absolutely.
But despite this, the fact that this bank is generally considered to be a leader when it comes to predictive analytics, they weren't anywhere close on retention. And I think, I mean, I'm glad you mentioned retention, because to me, that's the number one challenge that banks are going to have once this new sort of open data, more sort of portable environment takes hold, is all of a sudden there are going to be services that just exist to alert customers to the fact that they're getting ripped off constantly, right? Like, you're going to be able to share your data with services that tell you you're getting a bad deal. And so what banks do to push back on that, like, they need better weapons to help them with that.
And what you mentioned is phase one, right? Phase one is the customer's going to be alerted that they're getting ripped off.
Yes.
Phase two is you're going to have automation in place for you to automatically move your money from one checking account to another.
That's
and then
right.
There will be a technology company that solves this problem, and that solves all of discovery, right? And at this point, the bank has to rethink financial products and services and what is the real arbitrage for the customer to continue to bank with them. So banks across the world are already starting to think about it, but they have to execute this in multiple phases, because step one is to figure out what's in your data and then offer better products and services to your existing customers to make sure they feel valued.
Let me ask you this question as we wrap up. Outside of what we've talked about, cross-sell, marketing, retention, which seem like super obvious use cases and places to start from my perspective based on what we've talked about, where else are you looking in terms of unstructured data and this ability to generate features based on unstructured data? Are there any other sort of use cases that start to emerge towards the top of the list? Are there ones where you're like, yeah, we thought that would be a better fit, but it turns out upon more investigation, it's not as much? Like, what else have you sort of learned as you've vetted out these use cases?
There are a bunch of use cases. Credit risk collections and credit monitoring are all interesting use cases, but they come with their own regulatory restrictions and scrutiny. And what can you really do with this data? It's not a question of about, is a deep model better than the existing statistical models that are used, but also, do you really understand what's happening under this model, right? So that's
Although
an area.
I will say one thing you have going for you relative to the foundation models that are more broadly available from OpenAI or someone is a huge question I get from regulars all the time is, what's the data that the model is trained on? And so even if there might be a bit of a explainability challenge, or like being able to exactly diagnose how the models are making these decisions, the fact that you can at least say, this is our data that the model is trained on, and it's only trained on that data, that's a huge advantage relative to some of these other models from a credit risk perspective.
Correct. And even from an explainability perspective, right? If you've used Google or Facebook's ad targeting, they have these facets that you can target users on. And so we have similar facets. We have 300 such facets that we explain the model in terms of those facets, but that's still not enough for like a credit risk application.
Right.
But there are use cases that constantly get brought up in collections, in fraud, in like offers, rewards, retentions, churn. Travel is a huge area that people are trying to detect, spend, migrate, spend on, wealth management and insurance. But for sake of focus, we are only looking at like the cross-selling and the rewards and retention space at the beginning before we expand into other use cases. For a solution like ours, once you ingest a lot of the first-party unstructured data, the cost of adding on use cases is trivial. The first use case is a big challenge.
That's the one that costs you the money. Yeah.
Correct. But once you've done that, it often happens, right? Existing customers, they end up referring us to sister teams or product teams that can also benefit from predictive models for their use cases.
Right. Well, and that ability for the model to somewhat generalize across the banks, you're not starting from scratch, I would assume, when you're moving over to new use cases, even within one institution.
No, absolutely. Like in new use cases, we can onboard in a day. And so a big advantage is banks before us, like our existing customers, they would take like 40 to 60 business days to train a model from scratch with unstructured data. And with Hyperplane, they've been able to launch over 100 predictive models in a week. Right.
Wow.
So the ability for you to treat your entire AI stack as an API and you can just spin up predictive models on the fly, that accelerates experimentation.
Fascinating. I mean, everyone talks about being sort of the AWS of fintech or the AWS of financial services, but what you just described with the ability to spin up predictive models based on that sort of established sort of foundation model within each financial institution, that does sound much more AWS-esque. So that's pretty fascinating. Let me ask you this last question that I think is a good one to leave off on. Broadly speaking, if we look out, and I like to use 10-year time horizons because I think that's enough time for things to have changed meaningfully, but not so far in the future that I'm asking you to predict, population on Mars or anything like that. Where do you think LLMs and AI will most sort of broadly reshape financial services? If we're looking at like long-term impacts of this stuff, and we've talked a little bit about sort of the discovery arbitrage and kind of the change in how banks have to compete for customers. But where else do you see this kind of applying in a broad sense? Maybe that people who work in banking today aren't appreciating enough about like how this is going to fundamentally reshape what they do.
I'm going to answer this question with a caveat that I'm an outsider to the financial industry.
That makes you more qualified, honestly. Like we're so busy like living in the weeds of this stuff, we probably can't see the future. So use your outside perspective.
So I'm going to start off with our friends from Nubank, right? I think over the last decade, they've definitely introduced a world where they put a bank in every consumer's pocket.
Yep.
The next decade is going to be the decade where we will have an AI personal banker in every consumer's pocket. And what that really means is it's a tech company's solution to the financial world, right? Which is discovery will be perfect. The consumer will always know the best product for their exact situation without having to, like even simple things like finding a rental car requires me to check 4 different websites and I get 2 different prices if I check it on my phone or my desktop. But you're going to have an AI bot that scours the internet, finds the best deal for you for your specific situation, and even converts your money into the right account. So discovery is going to be perfect with an AI financial banker for you. The second change that I foresee is policies are today at the global level. Whether it's a credit policy, it's an offer policy, it's like one policy for the entire product. And this happens for banks of different sizes, right? Even the large banks are thinking of a single policy. And it's largely because there is a human team that is executing this policy. No matter how fancy of a machine learning model you have under the hood, they cluster and bucketize and make decisions at the cluster level. You're going to move that down to the user level eventually. You're going to figure out the policy for every user, and it's going to be slightly different from the next user. So the policy itself is going to be AI generated and AI managed. And that is just one of those dimensions that are going to change the cost to serve structures. But financial institutions are going to have a massive change in how they evaluate themselves and the cost to serve aspect of how they scale their consumer base. It is going to be possible for a bank to remain extremely lean if they don't care about growth or expanding their core product offering. Or banks are going to evolve into offering products outside of financial services. For example, in the Brazilian use case, we see banks going into e-commerce. You're going to see technology companies going into banking. You're going to see banking companies going into travel. And so the lines are going to start to blur between what are the products a bank offers. On the commercial banking side, there are tons of startups doing different kinds of CFO as a service, accounting, all of these things. But I don't see why a technology sophisticated bank offers all of these products out of the box when a new business signs up to have an account with them. They control the flow of money, so they definitely know enough to offer all of these value-added services as SaaS products on the banking platform. So you are going to see banks evolve to be offering products and services outside of the core banking use cases. And finally, the cost to serve angle, there is definitely some counterpoints. Like I know Jamie Dimon's been talking about adding more branches because branches tend to become profitable very quickly and all of that. So there's definitely a counterpoint to everything I'm saying today. But the reason I believe you don't need a branch is because today AI has not been solved from a trust perspective. When I am recommended something, as a user, you don't have my trust. You've not sold it to me that the AI is working on my behalf. Once we get to a point where models are explainable, and as a consumer, when a bot tells me that this is the best deal you're going to get on the market, I'm more likely to trust it because there is no way I can go and look at 100 other offers and compare against it. Once that trust is established, the need for a branch would go down. Today, the state of the art in terms of AI models and AI solutions are not yet there. Today, digital customers that are onboarded without physical branch presence don't have the same engagement rate, same LTV as physical customers that onboard through physical channels. But that can be solved with AI. We just haven't solved it yet.
That's a really great point. I'm glad you mentioned trust. And I think that's a fun one to leave off on because I was talking to someone about this in a wealth management context, but it also applies to like insurance and mortgage and a bunch of other areas. But it is strange how when a digital interface or a bot today that's a little kind of unsophisticated, to your point, in terms of its use of AI, when it tells us what the answer is, we're like, no, I don't trust that. And when a human being that I'm sitting across the desk tells us the truth and tells us what they think we should do, they'll add in a little statement that's very human sounding, like they'll look you in the eye and go, look, if I was telling my mom what to do, this is what I would recommend her. And like, that's a psychology trick. Like that person could be lying to us. We have no idea. But there is an inherent trust I have when I look across a desk into a person's eyes and they tell me what they would recommend to their mom. Like, that works in a context that like digital just doesn't. So I love the point of AI building up to the point where it can credibly challenge that human interaction in terms of which of these two things do you trust more, because it's entirely possible we shouldn't have been trusting people for a long time. I think we have plenty of examples of that, but the AI just hasn't given us enough good reasons to trust it in exchange.
And one way to do that is you don't have to use psychological tricks to win trust, right? Because today, when we read research papers, we trust the results because they're used to using references for every opinion they state. So AI agents can get to a point where they make a recommendation based on data, based on your data, and show you a simulation where every other use case you probably come out worse off. And so it's about not just recommending, but explaining that recommendation with credibility, with enough evidence, and using the data to make that argument. So I'm optimistic of this future, but it's going to take a lot of work to get there.
Well, I can't wait to see the work that you guys do. Thank you so much for coming on the podcast and humoring some of my dumb questions. This was a really fun conversation, and hopefully we'll be able to have you back in the future and you can share just how much the world has already changed. Rohan, thank you so much for taking the time.
Thank you so much, Alex.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.